Good morning. It's Monday, February 17th, 2025. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. You can follow me intra-week if you've got anything to say, either on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. Presentation you are seeing and hearing has been developed by us. It is designed for use with both financial advisors and investors, but each are expected to make their own investment decisions. Nothing contained herein should be treated as investment advice. There's no tax advice, no recommendation for the purchase or sale of any securities. Everything is strictly for informational purposes only. Well, last week, the S&P 500 rolled back on strong earnings reports, up about 1.5%. Mid and small cap stocks were basically flat, down, you can see just a tad there. But here, look at this. Look at the EFI index. International stocks continue strong outperformance on the year. Q1 up 2.66% on the week, and really over 8% for the year. Emerging markets participating as well, and bringing the ACWI up. And it's been a while since we've seen any sort of period of outperformance of international markets over the U.S. Admittedly, we're only 6 weeks into the year, but still, it's noteworthy. Bonds cut a bid last week, both the aggregate bond index up 20 basis points and the high yield bonds, again, no signs of recession, up about 30 basis points. 20-year plus index was flat to down about 15 basis points on the year. One of the things that happened last week that caused this outperformance of international markets has been a surge in European Union defense stocks. They mostly hit new record highs last week, as it is now widely accepted that American foreign policy is going to aggressively dictate that the European Union member countries spend a greater percentage of their GDP on national defense, and that without doing so, they won't be able to continue to rely on the continued expenditures of the United States. So the markets are taking this as reality and driving up those stocks. The defense stocks in the EU is driving up overall international markets, and that's causing that outperformance. In terms of economic data last week, National Federation of Independent Small Business Optimism Index came down from a more than 6-year high, came down to 102.8. Still a pretty good reading, just a little bit lower than expected, a little bit lower than the previous month. Capital spending plans had a large monthly decline, biggest since 1995. That was a bit of a surprise. An element that measured uncertainty surged 14 points. Tariff uncertainty, labor quality, and inflation remained the big concerns for the nation's small businesses. But by far the biggest economic news last week was the data received on CPI and PPI, CPI being the Consumer Price Index. Was expected to go up 0.3% in January. It actually went up 0.5%. Year over year up 3%. The estimate was 2.9%. So just a horrible report. When you look at the core, which is backing out food and energy, and by far more important because it moves more slowly, not that food and energy aren't important. Core CPI also ahead of expectations, 0.4, and 3.3, which is 20 basis points above expectations. So just a really horrible print. It really takes any potential for rate cuts this year. If it stays in this area, there's just no possible way we're going to see any rate cuts. We have to see these numbers come down. And as you can see, they really haven't been coming down now for close to 2 years since we started that downward trajectory. PPI, on the other hand, actually looks like it's going higher. If you look at this graph over here on the right, blue and red line both trending higher at this point. It's not just that inflation has stopped coming down, it's actually turning and going higher. And we talked about this 6 months ago in a lot of these reports about the potential for a reflation or a reacceleration in inflation. January PPI up 0.4, that was above expectations, 3.5% on year over year, 20 basis points ahead of expectations. Core, okay, just met at 0.3, but 0.3 is just too high and not a good print. And year over year, 30 basis points above the expectations here. And of course, what happens to producer costs gets passed on to consumers. So PPI becomes CPI. These both two very horrible reports. Also on the inflation side, we got import and export prices. Import price index at 0.3 for the month, 1.9 year over year. So that's not as bad. Export prices up 1.3 and up 2.7 year over year. It was well above the expectations there. And so as inflation continues not only to not go down, but has begun to reaccelerate, the bond market where inflation expectations are traded, these inflation expectations are showing that the 5-year break-even index, so this is how bonds are trading, is 2.65. Well, that's well above the Fed's target of 2%. And in the shorter term, in 2 years, the break-even is at about 3.2%. But you don't have to go back very far. Just last fall, summer and fall of last year, we were look at the 2-year break evens, way below 2%. They were like 1.6, 1.65. Everybody was thinking things were going great. The Fed thought they could start cutting interest rates to avoid any job losses. The longer term 5-year break evens had gotten down to 2%, but they're now up another 65 basis points from there. So just not good news on inflation at all. Where we do have good news is the continued just sort of aggregate demand in the economy. Weekly claims for unemployment remain very low. They dropped to 213 last week. Continuing claims 1.85. So demand is strong. The economy is strong. Optimism is fairly good across the board. We just have this one sort of nagging piece, this inflationary piece. Retail sales, well, they were down 0.9 in January after a 0.7 gain in December. Backing out autos and gas, they were down 0.5. But this was likely truly transitory events, wildfires and severe winter weather. The severe winter weather kept people in a lot of the country, and the wildfires prevented people from spending and going out and being consumers at the retail level in California. So we expect that'll be reversed quickly. Then we got industrial production and capacity utilization for January. Production gained 0.5%. Big utility usage because of the colder temperatures, so that should roll back out. Capacity utilization also a little higher, also will roll back out probably as the utility usage declines as we start to move past some of the coldest winter months. Okay number, solid number. Earnings continued great for Q4. We've now got pretty much everybody reported, 385 out of 500 S&P 500 names. Just under 300 of those, 287 have beat. Only about 70 have failed to meet earnings expectations. The average earnings surprise, you can see about 6.5%. The big earnings growth is consumer discretionary, another sign of a very healthy, strong overall aggregate demand economy. Financials had a great quarter, double-digit earnings growth there. Pretty good numbers for energy as well. In terms of anybody down, it was small industrials down just a tad and utilities down just a tad as well. So here we are. I have to say, I talked about in late December and early January, I think the markets are high. I think the valuations are high. I think they're justifiable, right? We're optimistic about the future. We're optimistic about economic growth. Aggregate demand is strong. The consumer is strong, and we've got a forward PE multiple on the S&P 500 now of 22. And if you look at this graph here, you can see on the lower left, in 2022, just 3 years ago, our forward multiple was 15. So we've literally had a 50% increase in valuation metrics. So yes, the markets haven't been on a tear. It's gone up. It's been fantastic. But here we are now. You can't really... I don't think you will. I don't think you can go from a 22 PE to, let's call it, a 31, which would be another 50% PE multiple expansion. You have to get the earnings. And the earnings are good. They're very, very good. But how much are we really willing to pay for these earnings as we get into this number? Given that I think there's this large amount, I've been talking about, hey, yes, we have a new administration and a new Congress that is pro-growth, that is pro-business, that is pro-jobs, pro-expansion. And all of these things, in a perfect world, are good for our portfolios, in our equity exposure of our portfolios. But I still believe that we're going into this period of heightened uncertainty around implementation of trade policy. And this is reflected in the monthly Global Economic Policy Uncertainty Index, that's a bit of a mouthful. But as you can see, at the end of last week, at the end of Friday, it hit an all-time high. And when you have Uncertainty. Uncertainty is the thing markets don't like. So I still think this correction is quite possible due to this heightened level of uncertainty. And we're sitting at 22, times for forward earnings and significant economic policy uncertainty. That risk premium that you're getting for equities, I think, has to go down. That means markets will go down as volatility is measured by things like the VIX index would likely increase from there. In terms of economic data this week, today we have President's Day, so markets are closed. We won't be getting any economic data. Tuesday, New York State manufacturing and home builder sentiment, neither of which look particularly good. Housing starts and permits will come Wednesday, along with minutes from the Fed's January FOMC meeting. Thursday, jobless claims expected to remain low at 215. Philly Fed, which comes on the back of that New York State, that's been a better number, and we expect it will be here again at 20. Friday, the flash readings from S&P Global on manufacturing and services. Remember, manufacturing just recently poked above 50. It looks like it's expected to stay there at 51.2. Services, which is 85% of the economy, has been carrying the economy for the last 3 years or so, expected at 53. University of Michigan consumer sentiment solid, 67.8, and January existing home sales expected to come in at a pace of about 4 million. Thanks for tuning in. We're back, of course, every week. We'll be back next Monday. You can find me on the YouTube, Apple Podcasts, Spotify, Deezer, you name it. But if you want the video along with the audio and you want the graphs and charts, make sure to look at Slaying Bulls and Bears on YouTube. I'm Herb Morgan. I'll be back to you again in 1 week.